Welcome to the deep dive. Navigating the energy market can often feel like trying to find your way through a dense fog, especially when you're looking for clear, actionable insights on a specific company. You get bombarded with reports, analyses, headlines, right? And it's just tough to cut through all that noise to figure out what really matters for your investment decisions. And that's exactly what we're trying to do here today. We're taking a really comprehensive analyst-style deep dive into Chord Energy Corporation. The ticker is CHRD. Our goal is simple: unpack this independent energy exploration and production company EMP, as they say in the industry, and pull out the most important nuggets of knowledge from recent reports. We want to give you that critical edge, help you understand what truly drives its value and what you, the American investor, should really be watching for. We've gathered insights from several pretty detailed analyses. They cover Chord Energy's business model, its financials, market influences, risks, even some technical stock indicators. Think of this as your shortcut to being genuinely well-informed about CHRD, giving you those aha
moments without getting, bogged down in all the overwhelming detail. I'm actually really excited to get into this one.
And I'm here to help synthesize all that complex information, provide some crucial context, connect the dots for you, the investor. We'll try to show you not just what the numbers or trends are, but maybe more importantly, why they actually matter to your portfolio.
Okay, let's kick things off then. Let's unpack the basics first. What exactly is Chord Energy and what's its core business?
Right, so Chord Energy Corporation, they're listed on NASDAQ, ticker CHRD, and they are an independent exploration and production company, an E&P company. Their main focus is finding, developing, and then producing crude oil, natural gas, and also those natural gas liquids, NGLs. And they do this primarily within a very specific, very resource-rich area, Williston Basin, that spans parts of North Dakota and Montana. It's probably worth noting, too, Chord Energy itself, it's relatively new. It was essentially reborn in July 2022 from the merger of Oasis Petroleum and Whiting Petroleum.
Okay, so a really focused player then in a very key energy region. That concentration, it seems like that would offer some pretty significant competitive advantages, right? But I guess, could it also be a potential vulnerability? Being all in one place.
That's a sharp question. And you're spot on, really, on both counts. Their main competitive advantages, as the sources highlight, they do stem from that focus. First, you've got the focused operations in the Williston Basin. It means they have deep, deep expertise in that specific geology, the infrastructure there. This allows for, optimized efficiency, better success rates, better production capacity. Second, as an independent E&P, they really emphasize rigorous production and cost efficiency. They're constantly refining techniques, managing costs super tightly to lock in profitability, even when markets get choppy. And third, they have excellent market accessibility. They've got access to both pipelines and rail facilities, which gives them flexibility in selling their products. That's crucial for moving oil and gas. Now, about the vulnerability point you raised, yes, absolutely. Being geographically concentrated does expose them more to region-specific stuff. Think local regulations changing or severe weather, infrastructure bottlenecks, things like that. But, and this is key, their deep expertise in those established relationships in the Williston Basin, that's precisely what helps them mitigate those risks. They can likely navigate those challenges better than maybe a less experienced player could.
Makes sense. And they're a significant enough player to be part of an important market index, aren't they? That usually says something about their standing.
Absolutely right. They are a component of the S&P 400 index. That's a mid-cap index. And that inclusion, it really boosts their market visibility, their liquidity. A lot of institutional funds track and invest based on index components, so it's a kind of stamp of approval for their market presence.
Okay, so we've got a good handle on the business, the advantages. Let's peel back the next layer and look at the numbers. Because, ultimately for investors, the financials are where the rubber meets the road. What story do they tell us about Chord's performance and financial health?
Well, when we dive into Chord Energy's financials, probably the most compelling story is their operational efficiency. They've been consistently surprising analysts, even with the revenue headwinds you often see in energy. For instance, their Q1 2025 earnings per share, EPS, that came in at $4.04, that significantly beat the Zacks consensus estimate of $3.60, beat it by over 12%. And in Q4 2024, the surprise was even bigger. They beat estimates by almost 27%. This pattern, consistently beating earnings expectations despite volatile energy prices, that's a really strong signal about their cost control and how efficiently they operate. Now, speaking of volatility, revenue for Q1 2025 was $1.215 billion. That was down from $1.455 billion the quarter before. That kind of quarter-over-quarter swing, pretty standard in the energy sector. And while they did manage 11.7% revenue growth over the last 12 months, the expected revenue growth for the full year 2025 is actually projected at minus 18.61%. So analysts are anticipating some market challenges ahead. But here's what's really critical for investors. Their cash generation is robust, very strong. They boast a 20% free cash flow ratio, which is excellent, and reported $2.347 billion in operating cash flow. In this industry, cash flow is absolutely king, and Chord Energy's ability to turn sales directly into spendable cash, that's a hugely positive sign. It shows they have the financial flexibility to fund operations, manage debt, and, importantly, return value to shareholders. Their operating margin of, 21.65% and a net income margin of 16.2%, those also really underscore their strong profitability.
That's an interesting tension there. Strong profitability, impressive cash flow, but these projected revenue headwinds. For an investor, which factor should carry more weight, you think? And specifically for folks focused on income, how reliable is that dividend given the market volatility we keep mentioning?
That's a really important question for a lot of investors. The strong cash flow, those earnings beats, they definitely suggest internal strength and efficiency. That's crucial. The revenue headwinds, though, they highlight that external market sensitivity that's just inherent to the energy sector. You can't escape it. Now, for anchor investors, Chord Energy is known for its attractive dividends. They offer an estimated dividend yield of 4.81% for 2025. That's based on an estimated $5.20 per share. That puts them in the top 10% or so of dividend stocks. Very appealing on the surface. Okay, sustainability. Their payout ratio for 2024 was around 62%, meaning they pay out about 2/3 of their net income. That's generally seen as a manageable level, suggesting the dividend is sustainable, under current conditions at least. Plus, their free cash flow growth, nearly 35%, that hints at potential for future dividend growth. However, and this is really crucial, their annual dividend per share has seen some pretty significant decreases in the past. It was way up at $27.03 back in 2022, now estimated at $5.20 for 2025. So that historical variability. It clearly shows that while the dividend is attractive now, it's directly sensitive to the broader energy market. So yeah, it's a potentially great income play, but one that requires you to keep a close eye on those underlying commodity prices.
Right. Okay. So we've dissected the company's internals, the financials. But I mean, no company operates in a vacuum, right? Let's zoom out a bit. Let's consider the wider forces, everything from company news to global markets that are constantly pushing and pulling on Chord Energy's stock price. What are the key micro, meso, and macro drivers we should be aware of?
Absolutely. You really need to look at it from all angles to get the full picture. So starting at the micro level, company-specific stuff, those consistent earnings surprises we talked about, they're huge. They signal operational strength, effective cost control. That always sends positive signals to investors. Chord Energy also actively manages its capital structure. Back in March 2025, they announced a cash tender offer for some 2026 senior notes, and they issued $750 million in new senior notes. That shows a proactive approach to optimizing their debt, improving financial health. Their commitment to ESG efforts is also worth noting. They put out a 2023 sustainability report last September, signaling dedication to environmental, social, governance factors. That can attract a growing segment of investors who prioritize that stuff. And don't forget their inclusion in the S&P 400 index. Boosts visibility, liquidity. Good things. And for those keeping track, mark your calendars. August 6th, 2025, that's when Chord Energy is scheduled to release their Q2 2025 earnings, always a key catalyst. Okay, zooming out now to the meso level, industry and competition. Here, the Williston Basin dynamics are absolutely paramount. It's their home turf. While natural gas production growth there is expected to slow down a bit, crude oil production in the basin is actually projected to recover, maybe up to 1.4 million barrels per day by the end of 2025. Infrastructure updates, especially pipelines, are also really key. They impact how efficiently product gets moved, and of course, technological advancements. Things like horizontal drilling, hydraulic fracking, they're crucial in this sector. Chord Energy, like its peers, leverages these to boost efficiency, get more resources out. Now, the competitive landscape, they operate alongside some big names. Continental Resources, Devon Energy, Hess Corporation, especially with their pending merger with Chevron, Ovintiv is another. But Chord Energy's competitive edge, it really comes back to that deep Williston Basin expertise, their relentless focus on cost efficiency, and that robust cash flow generation. They just know their ground incredibly well. Finally, let's hit the macro level, the big global economic picture, global oil and gas prices. This is the most direct, the most absolute impact on their revenue. As of late July 2025, WTI crude's around $65 a barrel, Brent's $68. Natural gas is around $3.99 per MB2. That's million British thermal units, the standard measure. The fact that U.S. crude inventories are falling, that's supportive of prices. And the 12-month outlook for WTI, it's projected to rise, maybe towards $73.71, higher prices, directly means more revenue, more profit for Cord. Simple as that. Then there's this complex dynamic, energy transition versus demand. It's fascinating. The World Economic Forum reported clean energy investment actually surpassed fossil fuels recently. But I also noted that overall demand for all energy sources, including fossil fuels, actually increased in 2024. So that highlights this ongoing tension. ESG pressures are very real, but fossil fuels, well, they're made essential, at least in the short to medium term. Inflation and monetary policy also play a big role. The Fed's interest rate decisions, they directly impact market liquidity, commodity prices. With the Fed holding rates steady now, but maybe anticipating a couple of cuts in 2025, that could generally be positive for commodity prices and maybe growth stocks too. And lastly, you can never ignore geopolitical risks. Instability in the Middle East, the Russia-Ukraine war, OPEC plus production decisions, these are constant wildcards. They can cause really dramatic oil price swings, hitting Cord Energy's short-term profitability directly.
Okay, so we've covered a lot of tailwinds, influential factors. But for investors, I mean, understanding the potential downsides is just as critical, right? What are the key risks for Cord Energy? And importantly, what internal strengths does the company have in its back pocket to maybe mitigate some of those?
This is absolutely critical. You have to weigh the risks. Let's start with the big ones. Number one, no question, is commodity price volatility. Swings in global oil and natural gas prices driven by supply, demand, geopolitics, OPEC, plus they directly hit Cord's revenue, their profitability, even their ability to pay dividends or fund capital expenditures. CapEx, the big money they need for drilling and infrastructure. Then you've got regulatory and ESG risks. As an energy company, they face ever-increasing environmental regulations, carbon emission targets, pressure from ESG-focused investors. That can mean higher operating costs or maybe limits on expansion. Their geographic concentration being so focused on the Williston Basin, while it's an advantage in some ways, it also means higher exposure to region-specific issues. Think natural disasters, local rule changes. Furthermore, production decline and reserve depletion. That's just the nature of the E&P beast. They constantly need to find new reserves, keep production up. That requires significant ongoing investment, which ties right back to high capital expenditures. Drilling is expensive. Infrastructure is expensive. If energy prices take a sustained downturn, it could really strain their ability to fund those necessary investments. And finally, for you income investors, remember the dividend sustainability risk. Yes, it's attractive now, but remember that historical variability. A significant downturn could lead to dividend cuts or even suspensions. Can't rule it out.
Those are definitely significant risks to keep in mind. So what's in Cord Energy's internal toolkit then? What core strengths does it have to counter these risks? Or maybe give it an edge over competitors facing the same challenges?
Right, their internal capabilities. These are really their core strengths, what helps set them apart. First and foremost, that deep, decades-long Williston Basin expertise. It translates directly into practical advantages. Higher drilling success rates, lower production costs, more efficient resource recovery. They just understand that specific geology and how to operate there better than almost anyone. Second, they are known for their operational efficiency. They maintain really strict cost controls. That helps them stay profitable even when oil prices dip. And that high free cash flow we talked about. That's clear proof of this efficiency. Third, they maintain a strong financial structure. They keep a solid cash position. They actively manage their debt like we saw with those recent bond actions. This financial flexibility lets them execute shareholder return policies like dividends and share buybacks. Fourth, they're leaders in technology adoption. They actively use modern shale techniques, horizontal drilling, fracking, and they combine that with data analytics to optimize production, drive down costs per unit. And finally, their experienced management team. They prove themselves through that successful merger that actually formed Cord Energy. Having seasoned leadership is absolutely crucial for navigating the notoriously volatile energy market and implementing smart long-term growth strategies.
Okay. Now, for those of you, the American investor who follow technical analysis, the charts, what are they telling us about Cord Energy's current stock movements? Let's say as of July 25th, 2025.
Sure, let's look at the technical picture for CHRD. With the stock trading around, say, $106.40, we're seeing a bit of a mixed signal right now, technically speaking. If you look at the moving averages, the short-term ones, the 5-day, 10-day, 20-day, they're actually above the current price. That often suggests a short-term sell signal, or maybe just that the stock is pausing after a recent run-up, taking a breather. However, the long-term moving averages, the 50, 100, and 200-day ground, those are all below the current price. And that typically signals a long-term buy or suggests the underlying upward trend is still intact, so underlying strength perhaps. Now, when we look at other technical indicators, the relative strength index, the RSI, it's pretty neutral. But indicators like the stochastic and the MESCD, they're actually flashing sell signals right now that suggest some short-term downward pressure or maybe that upward momentum is fading a bit. So overall, if you look at a summary like on investing.com, it shows a mixed picture. More sell signals from those individual technical indicators, even though the long-term moving averages look more like a buy. What does that mean? It suggests Chord Energy might be in a short-term consolidation phase, maybe a pullback, but its longer-term trend still appears supported. And as always with energy stocks, it's absolutely critical to watch the oil price movements alongside these technicals. Oil prices often dictate the broader trend here.
Right. So after this whole deep dive, pulling all these threads together, the business, the financials, the market forces, risks, technicals, what does it all mean for you, the American investor, trying to decide on Chord Energy? What's the bottom line here?
Okay, the bottom line. Chord Energy, it really stands out as an efficient E&P company. They've got robust cash generation and attractive dividend yield right now, and they're very strategically concentrated in the Williston Basin. So if you are an income investor looking for those attractive dividends, CHRD is definitely a candidate to consider. But you absolutely have to factor in that historical dividend variability we discussed alongside its current yield. Don't just look at today's number. Understand this is a classic cyclical energy stock. Your investment view, your decision, should be very closely tied to your outlook on global oil and natural gas prices. Where do you think they're headed? You also have to be comfortable with the inherent volatility of the energy sector. That means being okay with commodity price swings, potential regulatory shifts, and those geographic concentration risks we mentioned. Given that high volatility, it's generally wise, probably prudent, to consider CHRD as part of a diversified portfolio rather than making it, say, your primary holding. Spread that risk. And finally, this isn't a set it and forget it stock. Continuous monitoring is absolutely key. Keep a really close eye on energy market trends. Watch the company's capital allocation strategies. How are they using their cash? Dividends, buybacks, managing debt, and of course, pay close attention to those upcoming earnings reports.
We have definitely navigated the complexities of Chord Energy today. Now, as we wrap up, here's a provocative thought for you to mull over. How will the accelerating global energy transition, something we touched on, truly impact the long-term viability, the long-term valuation of even efficient cash-generative fossil fuel producers like Chord Energy? Especially where short-term demand for traditional energy sources, well, it remains pretty strong. It's a real tension there, definitely worth considering deeply. If this deep dive was helpful for you in clarifying your investment perspective on Chord Energy, please do consider subscribing. Thanks so much for joining us for this deep dive. We'll be back next time, ready to unpack more vital information for you.